The stock market, a bellwether to American capitalism. According to stockanalysis.com, there have been 442 IPOs in the US stock market in 2020, an almost 95% increase year over year, raising almost $150 billion thus far. This in the midst of a global pandemic. This in the midst of massive unemployment. This in the midst of lockdowns, and when lockdowns get lifted, social unrest. There are reasons for this. The biggest one likely being the stock market is hot, and momentum traders are driving the market higher and even higher for IPOs. People are rushing into stocks, they're rushing into IPOs. Airbnb gained over 100% on first day of trading, DoorDash gained 86% on day one, Zoom video surged another 80% on day one, and the list goes on and on and on. So, should you? Or is this a fool's game? Is it a good time to buy a stock during the IPO? Before we arrive at any conclusions, let's address some questions. Why does a company go IPO? How does a company go IPO? Who profits from IPOs? Does an individual investor have a shot at achieving any of these profits? And then we'll go back and address the question of, is it a good time to buy when a company goes IPO? So let's get started. Why does a company go IPO? As companies grow, they need more access to capital. Access to capital helps growing companies with the ability to fulfill large inventory orders, hire skilled talent, and invest in internal processes and technology to make their operations more efficient. It's a lifeline, and if not properly solutioned, could significantly impact a company's growth trajectory. There's two ways to get capital. One approach is to issue debt, and the other is to go to the stock market. Whether a company chooses to go the debt financing option way or the equity financing option way largely depends on how they want to organize their capital structure, and most companies typically use both. The differences between the two is that equity financing requires no repayment obligation and provides extra working capital that can be used to grow the business, but on the downside also involves giving up a portion of ownership. When you give up a portion of ownership, you could have additional voices telling you how to run your business, and the only way to get out of it is to buy out the percentage of ownership you gave up, which generally comes at a premium. Debt financing, on the other hand, does not typically require giving up a portion of ownership, but involves repayment of principal and interest on the loan. This has its own challenges, though, since you're on the hook for the obligation, even if the company has a downturn. Due to the risks of both, companies usually get both a debt financing as well as equity financing. And to access equity financing, you have to go to the stock market. And when you do that initially, it's called an IPO, or an initial public offering. Now, there are other ways to obtain funding. Private equity firms have gained prominence with the intent to support the business to grow, or perhaps gain efficiency and then to exit by taking the company public or selling it to someone else. How do you go IPO? The process of going IPO is an expensive one and involves several parties, including investment bankers, underwriters, lawyers, and accountants. Going IPO involves the scrutiny of the Securities and Exchange Commission, which has tight regulations. The objective is primarily to obtain a company's book for public scrutiny such that investors has all the information needed in a prospectus to make an informed decision on what the company does, how it operates, its financial results, why is it issuing shares, and the types of ownership structure that is being offered. The process for going IPO can be very expensive, and typically underwriters and investment bankers can take a cut of 4 to 7% of gross IPO proceeds to distribute shares to investors per global accounting firm PwC. This, combined with accountants and lawyers, could easily run into the tens of millions of dollars. A critical activity for underwriters is assessing investor demand and coming up with a market price, which is done through roadshows where they partner with management to drum up demand for the offering. Achieving the highest market price is in the best interest of the company and the underwriters, which is best suited in a hot market. Earlier, I mentioned that IPOs are most prevalent in a hot market. And this is the reason why. Underwriters and management get compensated based on how high of a stock price that they can garner from the equities market. However, what this does from an individual perspective is it really takes back some of the investment thesis which may have been derived from a fundamental analysis of the stock to determine what its actual stock price ought to be. So who profits from IPOs? The company and the underwriters have the most to gain. Market forces help drive the pricing of the offering, and the ideal price is where demand just slightly outpaces supply, resulting in a gradual increase in the stock price. The underwriters, further, are always pumping up the stock. After a month of trading, the underwriters write a report which further results in an uptick in the stock because it's usually always favorable. After 180 days, investors who got in the stock prior to it going public can sell their stakes.
Greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind. And
who has access to the stock? In most cases, individual investors do not have access to buy shares during the IPO. The underwriter gets to allocate shares to associates, clients, and major investors of their choosing. These are the same investors who are likely identified as a part of roadshows. Most of these shares go to institutional investors, which are major brokerage firms and investment banks. Typically, the remainder go to investors who have high trading volumes and traders with long-term relationships.
Instead of selling shares in an IPO the night before their first day of trading on an exchange, which that's under an underwritten offering by the banks, and they allocate them out to their clients, and then the next day, many, just if you look in the example of DoorDash, when they're doubling the next day, it means that those investors that took part the night before got a pretty good payout for not a whole lot of time risk in the market.
So finally, does it make sense to pile on? Make sense to chase an IPO? It seems akin to chasing a moving bus and trying to jump on a boat that's left the dock. The deck is stacked against the individual investor, and by the time they've put their order in, the stock has already had a run-up, so it's difficult to realize some of the gains that you may hear about in the media.
The top 5 IPOs this year on opening day were up nearly 200%. So, it's been a big year in IPO land, the best since 2014. 204 companies have listed so far, and IPO proceeds are up nearly 70% over last year.
So Natasha, though, when we look at these valuations, both of these stocks, as you point out, are trading at about 30 times sales. The average price to sales ratio of IPOs last year was 10 times. How can an investor justify getting into these at these levels, given not only that stat, but all the other stocks that are out there to choose from?
I'm not sure that they can. The question of how expensive they are, as you say, trading at 30 times versus 10 times last year, it's extremely rich given the lack of profitability. And again, if you peek back to the tech bubble for further context, you see stocks trading at 46 times sales on average. So 30 times is historically high, but it doesn't reach the tech bubble levels. I think both companies have very compelling business models. People understand why, but just not at these valuations.
Yeah, not sure people should want to be investing at tech bubble levels anyway. And Natasha and Mark, thank you for those insights.
If the stock is something that you actually want to buy and you're very interested in, it's usually most beneficial to buy the stock 6 months after the initial public offering or the IPO. Well, that's my opinion anyway. So now it's over to you. Do you think investing in an IPO is a good idea? And do you have any ideas in terms of when a person can and should and how they would be able to enter into an IPO? Insert those into the comments below. So if you enjoyed this video, definitely click on the thumbs up button, and if not, click on the thumbs down button and include a comment on the reason why. Further, if you would like to see more videos of this type, click on the subscribe button, ring the notification bell, and I will see you soon.